I told you we have another move to get to. It's in the financial space, which is one of the worst sectors this month, down 1.5%. So it's lagging along with a few others. You bought Wells Fargo. That's a new position for you, right? Why? Why that one?
If you think the economy is going to grow due to deregulation, ease of permitting, 100% expensing, you're going to have more loan demand. There'll be greater transactional volume in M&A. But with Wells, they'll benefit from all that, plus the fact that the asset cap has been lifted. All right. With banks, you have to look at two things: the ratio to book value and return on tangible common equity.
Give me a longer view, guys, so we can encapsulate what happened after earnings, please.
It's 1.9 times book compared to 3
there you go.
At JP Morgan. All right. So we also own JP Morgan, and the return on tangible common equity,
like a 1 month, please,
is roughly figure 15-16% and growing. They're aggressively buying back stock. And here's a stock that has not moved with the pack yet. So,
well, I mean, it had the big move off earnings, right? That's sort of what I wanted our viewers to see. That's what I was alluding to. There it is.
And it's going to go higher. Look at, remember, the ratio of to book value and the return on tangible common equity. Two factors compared to all the other banks. This is an attractive bank right now.
How about JP Morgan? Josh, which Cramer was suggesting could be the next company to hit $1 trillion in market cap. It's the only of the large banks that you own. He says, quote, the banks are on fire right now. Right now, this stock is ridiculously cheap. This thing trades at 15 times this year's earnings estimates. If we get a little multiple expansion and people say they start paying 17.5 times next year's earnings estimates, then JP Morgan wins the race in a heartbeat. What do you think?
Yeah, I mean, I'm long JP Morgan. I don't doubt that ultimately it could get to $1 trillion. I just don't know if it can continue to rise at the pace that it's been rising. And to Rich's point, I actually think the shorter term setup, I think Wells Fargo is a no-brainer. That stock looks like it's going to 100. Both of these names are on my list of best stocks in the market. Both of them technically look great. But I do think Wells Fargo, which is now just barely broken above the February high, whereas JP Morgan's gone all the way already. Like, this thing has already had its explosive move. So if I'm thinking purely about Q4 of this year, I think WFC is the faster mover. As a longer term investor, though, I'm not swapping out of one for the other, because long term, I do think that's right. I think JP Morgan will forever, at least for as far as the eye can see, be the larger of the two companies with the more premium valuation,
right.
and also outperform. So
let me get to the Berkshire downgrade, which I really want to hear your thoughts on, because it just doesn't happen that often. You almost never get a sell call on anything that would be tied to Mr. Buffett. So it happened yesterday. It's KBW, quote, many things moving in the wrong direction. You want to take aim at this here? What you think?
I actually think the analyst is right at what they're pointing out. And I think the real question is, so the issues that they're raising are real. They're not all new. So here are a couple of things KBW is saying. Margins are peaking at GEICO, which is one of their most important insurance businesses. On reinsurance pricing pressure, we really didn't have a big hurricane season this year, at least not yet. Thank God, knock on wood. The problem is you don't get the same premium growth if you're not doing new underwriting in the wake of a disaster. It's just how the business works. Everyone knows that. Knowing what the weather has been is not an edge. Lower investment income. Treasury yields are coming down. They own, $350 billion or so in cash on the balance sheet. Of course, that's investment income that will be lower. The railroad has China exposure. Oh my God, is that brand new news? I don't think so. Everybody gets
but should
that.
they not? Should they not have? Let's get a little provocative, I suppose, and pose the question: should they not have sold down? And I don't know the reasons why, obviously. So I'm just throwing it out there. Should they have sold down the Apple position the way they have? It's still huge, but that obviously gives them less of a chance to capture what has been a pretty darn good move by Apple.
Yeah, I read an article saying that Berkshire left $50 billion on the table by selling Apple. So they still, by the way, they're still in Apple, but they sold 2/3 of the position, and they shouldn't have. Yeah, okay. Nobody should have ever sold NVIDIA in the history of mankind. Like, I think that's disingenuous, to be honest with you. That kind of like going back armchair quarterback. They caught so much of the Apple move, not catching the last 20 points, and with the full position on, I really don't think is a black mark on the track record of Berkshire's investing. I think bigger picture here, the analyst raises legitimate issues, and probably Berkshire won't have as good a year in 26 as it had in 25. But I think most of the people who own the stock are not worried about 26. They're long-term investors. I'm in the B shares. So one B share is the equivalent of, it's 1,500 versus the A share. I'm not selling any, and I've sat through other downgrades of the stock before, only to see it go on to make new highs. So I'm not reacting.